Many income investors choose to create a diversified portfolio to help mitigate the risk of owning individual products. And there are different ways to diversify. In this lesson, we take you through some common ones to help you get started on the road to income investing. Ready? Then let's dive in. Holding products from different asset classes is called asset allocation. It can help balance out the different kinds of risks associated with different classes, like the volatility of equities or the lower returns of fixed income. These allocations aren't set in stone, and you can change your exposure to each class, meaning how much you invest in it while you hold your portfolio. Keep in mind that products in the same asset class are exposed to different types of risk too, so choosing a range of products within the same class may also be helpful. For example, common and preferred stocks both pay dividends, but because of the potential for higher dividend yields and lower volatility, preferred stocks are generally considered a safer investment than common stocks. As a trade-off, common stocks are more likely to appreciate in value. Diversifying further by sector can also be helpful. Government bonds tend to have lower default risk than corporate bonds, but corporate bonds come with the potential for higher returns. Fixed income products are also subject to interest rate risk and tend to be less liquid than equities. So diversifying your products by maturity date is often a good idea. To do this, some investors use a strategy called laddering. It works like this. Say you buy 5 fixed income products with different maturity dates. These could be bonds or GICs, but we'll use bonds for this example. The first one will mature in 1 year, the second in 2 years, the third in 3, and so on. Over the 5-year period, your bonds will mature at different times, spreading your inflation and interest rate risk. As your bonds mature, you can cash in your earnings or reinvest them. In this case, when your 1-year bond expires, you would reinvest it into a second 5-year bond to keep your ladder going. Instead of investing in individual products, an investor may choose to reduce their workload and spread their risk by buying mutual funds or exchange-traded funds, also called ETFs. Mutual funds and ETFs are like baskets that contain a collection of securities chosen by a fund manager for a fee, so the work of diversifying is done for you. You can choose the kind of mutual funds and ETFs you're interested in based on how much risk you want to take on. Funds that hold more fixed income products and fewer equities are typically considered lower risk. Inversely, the more equities a fund contains, the higher its risk profile may be. While some investors choose to invest exclusively in funds, others use them as a part of a wider income-generating portfolio. Before deciding how to set up your portfolio, there are some questions you may want to think about. For example, how much money do you need? How often do you need it? For how long? How much do you have to invest right now? How much risk can you tolerate? And what are the implications to your taxes? To help you answer some of these questions, a good place to start is the Goals tool in WebBroker. It provides self-directed investors with an intuitive way to create a financial portfolio based on their risk tolerance. Just click Goals located on the navigation bar in WebBroker to get started. And for your answers to your tax questions, see our video on making different sources of income work for you. To round off your list of things to know before starting to invest in income products, make sure to watch our lesson on income investing and the economy. Have more questions about income investing? See our schedule of upcoming webinars and masterclasses for instructor-led content and live insights from industry guest speakers.